Hello everyone, welcome to our today's session. We're extending subject from the previous session, talking about risk again, as this is a bit bigger subject, and I want to give more attention to this, as this is a very crucial part in whole your trading process, and needs to be well explained, and of course you as the traders will need then to apply it properly in order to have successful trades and minimize your risks, which are in this business quite respectable and high. So in order to keep you on track towards the profitable side rather than the losing side, we are applying risk management, and as I said, this is one of the key points that we need to have. We need to go over, and sometimes some things even to repeat that will be in your memories for the future, because as we said, it's quite important. So key things in trading is not many traders make mistakes by thinking how much money I'm going to make. Yeah, fine, that's good. But have you ever thought that the medal has the other side, and that side could be very ugly, and sometimes the reaction could be result could be painful. So instead of thinking how much money I'm going to make, you should start thinking how I'm going to protect my investment, and how I'm going to minimize the risk in order to have safe trades, and to maximize, of course, on the other side, the possibilities to make profitable trades. So there are some rules that are very important, and always you need to we have saying you need to stretch as long as your quilt is long, or as long as your bed is long. So do not overdo things. If you have certain amount in your trading account, you can use only the money that you can afford to lose. You cannot anything above this would be sort of gambling, challenging your luck, and most likely will end with the losses, because from my experience, I've seen many people overdoing things, being very self-confident in certain things, but missing to see the crucial things that are important. And in that blindness, they were just jumping from one to the other loss until they wiped out their accounts. And then they realized that there was something wrong, and then we sat down and they put things one by one on the table, and then they realized where was the problem. Most of them had a problem with the risk management. So the first thing is, we spoke in the previous class about this, is you need to trade with money that you can afford to lose. What I was saying previously from my experience and my rules, I always cancel the money that I risk. I cancel it. I consider it lost. So there is no psychological pressure. But you always calculate a certain percentage that you are willing and ready to lose. You can afford that without seriously harming your trading account, and then you can continue trading. Anything above or below this wouldn't be appropriate, especially if you risk more money than you can. Let's say if you have a $2,000 account and you risk half of it, that would be sort of gambling. It could, in certain situations, result in profitable trade, but why to play with this when it's a 50-50 in certain situations, that you may catch the move or lose half of your money. So it's better to reduce the risk, reduce the negative amounts on the negative side, on the wrong side, let's call it, and trade only with the money you can afford to lose. Also, when trading, especially the new traders, you should start with the reasonable contract size. So do not jump straight away into, especially those with the high leverage, then they jump into a few 100,000, even million account without having experience, without knowing how the market behaves, how the market can move suddenly in unexpected direction because you thought, yes, it's going downside, it's strong downtrend, and then something comes and just spoils all your expectations. So it's better to trade with reasonable size of the contract with the part of your account deposit. So you are not going to use whole deposit in order to cover one or two trades. That will be again gambling. You have to specify how much you are willing to go in one trade. Also, you don't need to jump into 5 trades. Let's say if you have 5,000 or 500, let's say, and you want to put all this money in game. So you will open 5 positions on 5 different instruments which behave differently. Could be very dangerous. So you need to control the risk by trading the money you can afford to lose, trading a reasonable contract size. So don't jump straight away into something that is high risk. Rather go step by step, slowly, gradually. You need also to gain a lot of experience. As experienced traders sometimes can see and spot some things easier than those who are not experienced, which is very normal. So we need to gain our experience first by going step by step, slowly, without making extra steps, without jumping into territory that is not known for us, that could be dangerous for us. You need to go slowly, and this will give the best results. Now, also you have to control your risk with stop loss orders. We spoke about stop loss orders in the previous session, but I'm going to repeat as this is quite important. So once you open the trade, the first thing is to place your stop loss with the money you can afford to lose. So you are risking certain percentage that will not harm your investment seriously, and you consider that even if this money is lost, that will not be big damage on your account. So you control your risk by stop loss orders. This is one of the important things in Forex trading, in this case that we're talking about. So if you want to stay in the market, if you want to remain in the game, you have to keep your risk low. Anything else? This is again what we spoke just now. Any higher amounts, bigger amounts, anything that could distract your general position regarding amount of the money in your account, regarding the positions, will drive you towards the negative territory, and we are trying to avoid. So it's keeping a low risk. If you risk, let's say, 2% or 3%, it's quite reasonable. On 1,000 is not much, but you will still have some space to stand some wrong moves, and hoping, of course, you need to study the market, analyze, and see which are the levels that are important on the wrong side. And usually traders put just slightly below or above these significant supports or resistance, and hoping that the market will bounce from there, even if it goes. But in case the order is executed, it means that you have lost only the money that you have planned, and you can afford losing. So there will be no big damage. Of course, a wrong trade is a wrong trade, but it's not end of the world. So once a wrong trade is done, we already spoke about this. I suggested to reanalyze the market, check everything properly, probably to look for some other or better opportunities, or simply take a break and don't trade anymore that day or that session, just to get relaxed, and then you will be able, once you re-enter market, you'll be more concentrated and focused. Proper risk management will also help you to focus on the other side. So once you are relaxed from the wrong side, let's say, and you, after analyzing, enter the trade, hoping that the market will go in your direction, you placed your stop, so you are relaxed from that side. You are already accepted that certain loss that you can afford is there, but hoping that it will not be hit, but you can then turn your focus on making profit. Many traders make mistake by thinking only about profit. That's what I mentioned, not focus on the risky side. I would say the first thing is to protect yourself and then start thinking about profitable side. Forex trading, as it is, it's a speculative method. So you speculate about something and you have a big variety of tools such as technical analysis, fundamental analysis, news, economic indicators, releases, political events, wars, name it, which all influence the market, and you already know, okay, some things that are unexpected happen, but it's not a rule, it's a rather exception. So when you have all these things, you can speculate more clear, and you can have more, I would say, safer direction for your trade. You can estimate where the market is going and up to where it could go. So it means that it's sort of a study compared to the gambling, which we already mentioned. This is purely playing with your luck. So if it hits your number, that's it, you win. If not, then you lose. I have to mention something that is quite interesting. In reality, when you go to roulette, how many numbers there are on that circle? If you play on one, so your chance for winning is 1 against all these numbers. Those who are addicted and those who see the opportunity high to make money and are sure that this time when they put on certain color or number, they will win. They see it 50-50. So either it's going to hit my number or it's going to hit any other. Basically, yes, there is sort of fact in this, but generally it's 1 against all these other numbers. So it has nothing to do with the gambling, and our behavior needs during trading needs to be adjusted in that direction, not as a gamblers, as investors, as traders who know what they are doing at any time, who can make profit. They can also make losses. This is not end of the world, but will know how to stand the bad situations, how to emerge from bad situations, how to rearrange things, make new plans, new strategies, but at the same time always applying a proper risk management strategy that will have control over their risk and will not keep them at risk to lose a significant amount of money from their trading accounts, but only the money that they can afford to lose. So proper risk management policy is one of the key points of Forex trading. So it needs to be always taken into consideration, needs to be properly applied, requires, of course, studying of the market, expectations, projections, forecasts, all these things that could affect the market movements. And then based on this, we enter the market and apply our risk management strategy. Risk management, itself, it focuses on money that is at risk. So we are focusing on the wrong side. Is it it is how much we are ready to lose, and of course we are not negative at the beginning, because negative people with thinking in a negative way. This is with the half glass full or half empty. We need to see the glass half full, because if we make study and we expect, let's say, euro dollar to go up, then we have to support our theory by facts that are showing us technical analysis pointing this fundamentals are working in favor of euro, dollar is down. So all these things, risk appetite is up. So all these things will help to support our theory. And then risk management comes to protect us in case something goes wrong. We're going to apply our risk strategy, put our stop loss orders, and escape from this situation that could escalate into God knows what. I mean, if the wrong move starts, you don't know when it's going to stop. So if you are risking all the amount without playing stop loss, then you don't love yourself, you don't love your investment, you don't love your money, you just have wrong thoughts about everything, and you need to sit and think, well, what is going wrong? Because it's something wrong with the trader, not with the market. Market is always above everything. So you have to respect this market and move accordingly, move with the market, not against the market. And if you are risking too much, then obviously that your trades will be mainly not successful, and total numbers, when you underline everything, will be most of the time negative. And this is what we are trying to avoid. As I mentioned, one of the mistakes is that many traders focus on the money they are going to make. I've seen many, when they come, they are so optimistic, and I'm going to make money. I have money in my account, and that's it. No knowledge, no strategy, no plan, no nothing. And then when they jump in the market, market goes wrong, and they say, what to do now? You need to know first how you start. Even if you open an account, you don't trade on that live account with real money before you learn the basic rules of the market, how it functions, how it works, what are the main drivers of this market, and what are the main risks. This is very important, because risk management is all about protecting your funds that could come at risk or increased risk. So you're trying to minimize this risk and maximize the on the other side, profitable side. So risk management is all about this. So if the trader starts its trading with the wrong approach from the beginning, then it will not, obviously it will not end up in a desired way, but will end up with the losses. I have to say again, I've seen in my career many of them just losing money until they learn. Once they learn, okay, it's a very expensive school. Some can afford, some cannot, and majority cannot. So we're going to talk about this also in a while, which is very important. So it's better to learn before you go, before you start, rather than learning on mistakes. And there is good saying that a clever person learns from mistakes of others, a stupid one learns from his own. Sometimes it's good, because more painful is the case that you have the lesson. It's more likely that you learn the lesson well, and more likely you're not going to repeat it again. But unfortunately, humans are sometimes jumping before thinking, before evaluating, before studying, and it costs them. So we are trying by all these classes, trying to form certain way of thinking, certain behavior that will be, if nothing else, helpful to reduce your losses, but I believe that will help to go towards the profitable side. What is important, we have to mention about online trading, which is the most popular today, especially with the leverage. We spoke about leverage in the previous class. This is a quite risky game, and you need to be aware of this. The brokers that give 50 to 100 to 1 or even higher, they're in a way facilitating you. But as we said, as much as you maximize your profitable side by multiplying your initial deposit, the risk is also multiplying. So if you have 100%, if you have chance to make 100% more profit from your original deposit, you also have risk of making loss 100%, 100 times, let's say, more bigger than your initial deposit. So it's a risky play, and traders need to learn this and need to be very aware of this and adjust their trading policies, their whole approach to trading to this. It's better to trade with a lower average, with smaller amounts of money, rather than jumping into something that maybe you are not very familiar with, or it simply is too risky. So why too risky? If I have 1,000 in my account, why to risk whole 1,000? as a broker facilitates me to go, let's say, for 5,000 from 1,000, why shouldn't I risk? Because this is again what we said, people focus on how much money they're going to make. They don't think how much they can lose. So if it's like this, then it's quite dangerous. So it's better for new traders, those who are not experienced enough. It's better to go step by step, analyze the market well, see what are the most liquid, most active financial instruments which look familiar to you, or which you like. Let's say when you see certain instrument moving in a nice and smooth direction, which is trend, regardless which direction, then it's much more attractive for us who learn that trend is your friend, rather than some choppy market that goes 50% up, 50 points up, 50 points down, then goes left, right, without clear direction. So it could be risky, because once the market will jump out of that congestion, and if you are standing on the wrong foot, you are going to suffer, you're going to lose your money. So you need to analyze and to find something, and then once you find the instruments that you think are going to be good for trading, then you need to apply your strategy, the proper one that you see. When you choose the strategy, then you test them, obviously, and testing is highly recommended first to be done on the demo accounts without having painful losses due to possibly some wrong things in the strategy, or simply not understanding markets well. So you do your all testing on demo account, which is artificial money, not real, virtual, and then you find the best strategy and apply it. And of course, work in lower risk mode. So do not risk, for especially the new traders and the less experienced traders should not risk much. It's better to learn slowly. You build your knowledge about trading gradually, and you don't need to lose all your money in one or two trades. Instead of that, it's much better to go with the lower risk mode, with the step-by-step trading, making small profits or small losses, but to have certain steadiness until you learn how it works, and then you can, of course, take some riskier steps. So diagram shows how it works. It's a circle, basically. So you first need to identify this risk. What is this? In this case, our risk is if the market goes against us, then we assess, we see how much it can harm us, up to where the market can go. So it's a high risk, let's say, of reversal in the market. We are long on something and it goes, but there is a threat of reversal, and then we need to calculate how much money we are ready to lose, we can afford to lose, place our stop loss, and then control this risk by holding this stop there. So as long as the market is profitable, you keep your stop there, and of course you keep reviewing it as market progresses in your direction. You keep raising your stop, so at one point you will come to zero, so you will have no profit but no loss, and everything above that or above or below that, depending on market direction, will be your profit. So you need to control this risk. It will not be risk anymore, it will be profit, but it's a good thing that you control your risk from the beginning. Important rules that I always mention to new traders, that we already spoke. Never trade the money you cannot afford to lose, and the money for everyday use cannot be used for trading. I remember the case many years ago. Wealthy businessman became our client, trading with a reasonable amount of money, $100,000 or $200,000 for the beginner. He had some knowledge about this, but it proved to be quite brief, and what he heard from people, what he learned from media. And then he started without plan, although I spoke to him and I explained to him that it's quite risky, and he had also the family member involved in trading, and the person also made a mistake and lost some reasonable amount of money, but he learned mistake. It was quite painful, quite costly, but he learned. Within 1 year, he learned everything. And then for a number of years, his trades were profitable. I was following him. It's amazing how systematic he was in his trades, how he was playing with stops, how he was calculating profits and minimizing losses, and he managed within 1 year to recover whole losses. It was very significant loss, and since then he was profitable. Now the other one who started in the same manner had an opportunity to hear the essence of trading, because his family member learned, and he was trying to tell him, but this one was not listening, thinking that, oh, I'm younger than you, I'm more clever, I know what I'm doing, I'm a businessman. In his field, he was extremely successful. But when you come to the new terrain, new territory, you are not aware what is somewhere slippery, is the ice somewhere thin, are you going to fall into the mud? Plenty of traps that are ahead of you, and you are not aware of them. No matter how much you are experienced in the other side, here you come to the thin ice. So he again lost significant amount of money, and then we spoke one day, and he said to me, you know, this money that you use every day for bread and milk, and exactly using these words, cannot be used in the market trading. I said, of course, cannot. You had a good sample of someone close to you who also played without knowledge and lost. Yes, he said, I didn't listen. So money for paying bills, money for paying school for children or something, should not be used at in any case for trading. Trading is something that you can spare and that you can afford to lose that money. So if you have 100,000, let's say I can risk 10,000. So these 10,000 I will take for trading. The rest of 90,000 will be used for other purposes that was originally planned. So I can afford losing 10,000 even if I lose them, if I not lose them, but I'm risking these 10,000. So this is the only proper way. So you have to use the money that you are you can afford to lose. Anything else will bring your life into very difficult situation. You will become short of money, and then a lot of troubles will come in chain reaction, domino reaction. You cannot believe how it's difficult once you put yourself in such a situation. The good sample, let's say, is with the gamblers who come into casino. They make some money and then they start losing, and what they do the beginner's mistake. They want to recover. That's the worst thing. Once they start recovering, they will lose everything. So this is the thing, something that you can afford to lose, $100, $1,000, $1 million, according to you, to your assets. If you lose them, you can say, okay, I lost them, and it will not harm my everyday life. I tried, I didn't succeed, but my main money, the biggest what I have, the biggest asset that I have is untouched, so I can continue. Nowadays there are some changes in the regulations, because, as we said, leverage trading is becoming quite risky. Due to increasing competition, and financial brokers are trying to attract new traders by increasing leverage, but regulator bodies in countries are working hard now to impose some more strict rules that will reduce risk on traders, because traders are the most vulnerable in this chain, and their money is at risk. So by applying rule with the lower leverage, will simply not allow traders to gamble, to open big size of position with small amount of money. So let's say if you have $1,000 and they give you 100 to 1 leverage, or 500 to 1 leverage, which is also common, then all of a sudden you are operating with, let's say, $500,000. You have never seen on TV even so much money, and it's quite risky. especially if you are a new trader, if you are not familiar, very familiar with the market nature, market movements. If you are not aware of risks, which is the most important, then you are at the best way to wipe out your account, lose all your money, and then think, what happened to me? So most of, actually all regulators, regardless whether they are from states, Japan, European Union, are working on changing this regulation that will work in favor of traders, not in favor of providers of financial services, but in favor of traders with reducing leverage that will give them more realistic picture when you trade with 1,000, let's say, and you can trade 2,000 with this. That's much more realistic than if you have $1,000 and you are allowed to trade with 100,000. What is important for traders? It's not to jump and to say, to prove to yourself, yes, I can make 10%, 20% per day. I made $2,000 today, because anything that suddenly moves in one direction most likely will reverse in the opposite direction. It's like market that moves in cycles. You have strong move up, let's say rally, and then the traders come and collect their profits and start selling. So this rally reverses quickly, and most of the time reverses the biggest part, if not the whole move. So it is when you make significant amounts in a short period of time and significant percentages according to the size of your trading account, that should be first alarm for you that maybe you should reduce the speed and think taking a break or something. I would suggest that it's much better to have a sort of a stable and continuous gains, regardless that they are much smaller than what you plan, what you think, because we all want to make 1 million in 1 month. It is theoretically possible, but practically it's quite tough work, and a million per month can make those who have $10 million accounts easily. But if we are traders with $1,000 or $5,000 or $10,000, then we have to adjust ourselves according to our account deposit. So it's always better to have stable and continuous gains, because if you apply proper plan, proper strategy, and proper risk management, then it's much more likely that you will end up your trades with profits. Don't be greedy. Don't jump into something, chasing something, because chasing a price could be quite dangerous. We spoke about this in the previous class. So it's rather to have a record of continuous smaller profits, but steady profits, rather than jumps of 10% or 20%, 1,000, 2,000, which could easily convert into losses. So stop loss orders are one of the key points in protecting our trading position. We already explained the meaning and point what is the stop loss order, but I would like to repeat this, because I've seen these days a number of traders that are trading without stop loss orders, and despite keeping telling them it's not right, it's risky, they think they know. So we'll put them in the group of those who learn from their own mistakes, because most likely big percentage or a high percentage of them will end up with losses. This is the rule in the market that works for years, and it's not going to change because of me or you or someone else. The market is much bigger than us, so if we don't protect ourselves, the market will not protect us, will eat us alive. So stop loss orders is a good thing. It's recommended. It's part of important part, the most important part of risk management. So you can always jump out of the market at the level that you calculated with the money you can afford to lose without harming your deposit. So you simply planned something that you can lose, and that's it. Stop loss orders are so-called emergency exit for you. So in the case that market becomes very wrong, starts going in the opposite direction from your trade, they are activated, and they protect your money basically, because if you are long euro, let's say from 120 and euro goes to 122, and you say, great, I'm going to, as many traders think, let's take a few more pips because market is moving. So we are not applying our plan, our strategy. We planned, let's say, to take 100 pips. Regardless that market will go another 100, we can re-enter the market, but we need to book our profit. We need to take it out. And then market goes to 122.15, let's say, and then jumps back to, falls back to 120. And we entered, let's say, at 120.50, so we lost 50 pips without thinking that a few minutes ago we had a good profit in our, not in our pocket, but we had it in our balance. So if we were clever enough to have a stop loss order and keep adjusting it, moving it higher along with the market, we would have avoided all this risk and end our trade with the significant profit. So it's always highly advised to use stop loss orders in order to reduce your risk. Another important thing that I want to mention that is very helpful are trailing stops. Trailing stops work in a way when you place your trade and the price, let's say you buy something and the price starts going up. You calculate your stop loss, for example, at 5%. So you bought certain asset for price of, let's say, $10. So 5% loss will put your stop at 9.5, and the market starts going higher. So it goes to 10.5, 11, 12, 13, 14. Trailing stop will continue to follow, but it will be always 5% below your price, your 5%, pardon, below the current level of the market. So in the diagram you can see it. We started somewhere here, and the stop, as the market proceeds higher, the stop is moving along with the market. As long as the market moves, stop is moving. So if we bought, let's say, at 20, at 10, and the market goes to 20, our stop will be 5%, so it will be at 19, and will not go down if the market starts moving lower. So trailing stop goes along, is dragged only in your direction, and then stays there 5%. Let's say if we choose 5%, stays below the the highest price. So once the market starts moving, your stop loss will be executed here. So you bought here, you sold here, and all this is your profit, thanks to trailing stop. It's easier to handle rather than the ordinary stop loss order that you need to move manually. But with the stop loss, you can play, you can keep adjusting it, while trailing stop is always adjusting automatically and with the percentage that you decide. So if you decide 5% is going to move along with the market 5%, but will stop below 5% below the highest level of the market in case of an uptrend, or on the downtrend, let's say it will be above the price. So it's quite a good. Stop loss is good. It's recommended, and it will greatly reduce your risk of losing more funds than you can afford. At the end of the day, when you underline your trades and you see that you lost, let's say, 700 from $1,000 account, it's a bad result. But if you lost 100 from 1,000 on one wrong trade, that's acceptable. So you risked 10%, not more, and then at the end you have enough funds to continue next day. Of course, with analyzing market again, studying your strategy, and probably looking for some better strategies or something that will be more suitable. However, you have time and space, and the most important, funds in your account that will allow you to continue trading rather than being wiped out and having small amounts or zero in the account that will stop you from trading. Hedging is another thing that is used in the market. I wouldn't suggest it to new traders, unexperienced traders, because it's sort of a game. Personally, I don't find it interesting, and I don't find it as a clever idea, but many traders use it. It simply goes that when the trader comes to the market, he or she opens one long position and one short position, so buys and sells at the same time. And hedging starts working when the market starts moving in certain directions. So let's say if you buy and sell, the market starts moving higher, so your buying proposition will become profitable, while selling position you simply cut. You close it with certain loss, and then let your long position run, and vice versa. If the market starts moving down, you simply cut your upper position and let the market move down. This is risky, because the market is not guaranteed that the market will go in that direction for some time. It may go few pips, maybe 50 pips, and then just quickly reverse back and go through your level, and then you are all of a sudden you are at loss. So I wouldn't suggest this for unexperienced traders, for new traders. Let's leave it for those who consider themselves professionals, rather than having risk, because sometimes it's a bit difficult to follow, and it could be more risky. So we'll rather stick to our ordinary methods that we already studied in our classes, and we'll try to apply them rather than increasing our risk. Hedging is also used when traders have certain position at loss. For example, buying euro at 120, and today is ending at 115, and they don't want to close this position with loss, because it's a psychological point that if you liquidate, if you close position, then you booked your loss. So what they do, they sell at the same level. They have the same float, but this time floating loss of the same amount, and hoping that the market will move in the right direction, and then they will be able. But once you sold on a negative long position, I don't think you can do much to recover these losses. It will require a lot of hard work, but without some significant results. So I wouldn't suggest hedging as something for the new traders. Let's leave it to professionals. And I think that will be all for today.